Hello, everyone. I hope everyone is fine. We are just finalizing our topic, I-36, impairment of assets of financial reporting. Actually, in the previous sessions, we studied a lot about objectives of I-36. We read about the scope, we went to definitions, impairment, measurement of impairment, computing recoverable amounts, which are fair value less cost to sell, as well as value in use. We went to check indicators of impairment, annual impairment reviews, then a reverse of impairment loss. And now today we are just going, this is our new section. This is the last section of our topic. And after here, we'll just be conducting more questions so as to understand more. All right. Our session today is on cash generating units. So we have to use about 20 minutes and I hope we have completed cash generating units. What are cash generating units? This is the point. In the normal cases, we usually compute impairment losses for individual assets. You have individual assets and they compute the impairment losses, but it may happen that some assets are difficult to compute impairment separately. And so we categorize them into one thing, a cash generating unit, and compute, let's say it's a group of assets, and compute impairment loss of the whole cash generating units and start allocating that impairment loss to several assets. So that's why we are saying cash generating units is not a separate asset, it's a group of assets. So here we are saying that when assessing the impairment losses, it will not always be possible to base the impairment on individual assets. Not always possible. It is not always possible to review on individual assets. So if it's not possible, you will have to determine impairment losses of a group of assets and then start allocating that impairment loss to some assets. So here we are told that the value in use calculation may be impossible on a single asset. I think you know the meaning of value in use. When computing recoverable amount of the asset, we usually compute value in use and fair value less cost to sell. Now, when saying the value in use is the present value of future cash flows. Now it's difficult to obtain future cash flows of each asset. A lot of assets work in combination with others to give an output, to give the required output, which is the objective of the organization. So since the value in use may be impossible to compute on a single asset because individual assets does not generate distinguishable cash flows, and individual assets cannot generate distinguishable cash flows. Of course, most of the individual assets are like that, except for assets like investment properties, which can usually generate cash flow that are largely independent of other assets. Now, why CGU? What is a CGU now? Let's go to the definition of a CGU. Then after going here, we'll go right away to an example and see how to proceed with that example. So here we are told, what is a CGU? A CGU is the smallest identifiable group of assets. It is the smallest identifiable group of assets. You combine, since you cannot obtain the impairment loss of a single asset, you do your best to combine the assets to the smallest quantity in the smallest group as possible, so as just to be able to compute the impairment loss. So we are saying it's the smallest identifiable group of assets that generate cash flow that are largely independent of cash flows from other assets. So just try to separate the assets as much as you can. As long as they can generate independent cash flows, that means you can use them to obtain the value in use. Obtaining the value in use is one of the essentials in computing recoverable amount. I hope everyone remembers about the recoverable amount. When trying to compute impairment loss, we usually compare two terms. Let me just make a revision a bit here. To determine whether there is an impairment loss or not, impairment loss, you ask yourself, is there an impairment loss or not? You have to go down and compare carrying amount versus recoverable amount. Now, you compare these two and reach a conclusion. How do you obtain the recoverable amount? This recoverable amount has two choices. We usually take recoverable amount at the higher of two options. If you have your asset, but you need to recover something, it's either you sell it or you continue using it. If you sell it, let's say that you can obtain the fair value, less cost to sell. It depends on the costs which will incur to sell that asset. Compare higher or fair value less cost to sell and value in use. So we compare it with value in use. This is your value in use. Just like this, you compare the two values and reach at your decision. So here we are speaking about this, how to obtain this value in use. Value in use depends on future cash flows. Simply speaking, value in use is the present value of future cash flows. Present value of future cash flows. Now, since it's a present value of future cash flows, and most assets cannot generate cash flow that are largely independent of other assets, you find yourself in a dilemma such that you have to combine your assets to the extent that they can generate cash flow that are largely independent of cash flows from other assets. I hope you get the concept. I hope you get what I'm just trying to illustrate. So this was my point here. I think you can proceed now. Now let's finish up here and then we go to solve the question to see a worked example. So we proceed that impairment calculation is achieved by assuming cash generating unit is one asset. This is what we assume. You assume a cash generating unit. Since it is a combination of assets, we just presume it to be a single asset, compute its carrying amount, and then comparing that carrying amount with its recoverable amount. And that's why we say, and comparing the carrying amount to the recoverable amount, just like the normal principles of the impairment laws. For the previous videos, for the previous lectures, actually, you can just go to the YouTube channel called Hybrid Accounts. Actually, I'll share in the group. You can just go for previous. But right now, today, I just want us to go to compute the impairment of a cash generating unit. This is our main topic today. About 20 minutes, I think we have completed. So we proceed. As usual, impairment exists where carrying amount exceeds recoverable amount. I hope you understand this, that the main aim of I-36 impairment of assets is to make sure that assets are not stated above their carrying amount. I mean, assets are not carried in the books above their recoverable amounts. Let's say you have the asset of $5,000, but you can only recover $4,000. That's very wrong. It's like you have overstated the assets. We try to put in the concept of prudence first to avoid this. So if the carrying amount exceeds the recoverable amount, that means the asset is impaired and you have to impair it to reduce its value. So let's go directly. This is the last point, and after here, we'll just go directly to questions as you see here. So let's just finish up on this and then we'll go to the question. So here we are, impairment of a CGU, impairment of a cash generating unit. How do we go about this? How do we solve the impairment of a CGU? These are the steps. Be very careful when conducting them. So first of all, we're told, start with any specifically impaired assets first, then impair the CGU. So it might happen that, let's say, the CGU has been impaired just because maybe there was a fire broke out and some assets were burned in full or maybe partially. So you do not have to say you want to compute impairments. It's pretty evident that some assets will be totally burnt. They'll be impaired in full. Their value won't be normal, will be normal. So what we're trying to say here, first start with specifically impaired assets. This will be stated in the question. And then impair the CGU after specifically impaired assets. Now, how do we go about the CGU? We say here that I-36 requires that an impairment loss attributable to a cash generating unit should be allocated to write down the assets in the following order. This is the order which we follow when impairing the asset. First of all, purchased goodwill. Let me tell you one thing, be very, very careful. Goodwill is an intangible asset and it's very, very volatile. So, goodwill just being reliable to the customers, giving products with a good quality makes customers trust you. Their trust in you actually adds up goodwill. That's why when you sell your business, you will sell it at a higher value than what is seen in the books. or than what is its actually its fair value. So first of all, when something bad happens, goodwill is usually impaired in full. So try to impair goodwill as much as you can. Of course, in case the total impairment is less than the value of goodwill, then that total impairment will be the reduction of goodwill. So first of all, remove all of the purchased goodwill, remove it all, remove it in full. Of course, I'm just speaking of purchased goodwill because, as you know, only purchased goodwill is recorded in the books. Internally generated goodwill as per I-38 intangible assets is not allowed. You cannot recognize that, because its cost cannot be reliably measured. So start with purchase goodwill, remove it in full, and then the other assets, including other intangible assets. Not just because I've said purchase goodwill, I ignored, and that we just go to other assets, other intangible assets as well. No, for intangible assets, just go in the normal way. So go to the other assets, including intangible assets in the CGU on a pro rata basis. This is our main point here. So after actually writing down the values of assets which are specifically impaired and actually dealing with goodwill, the amount that remains actually is just distributed to the assets on a pro rata basis, which means the asset with the high amount will have a high impairment loss. As I said here, based on the carrying amount of each asset in the CGU. But also you have to note one thing. You know, when having a group of assets, you could have current as well as non-current assets. Now, what of current assets? What do we do about current assets? You know, let me tell one thing. Impairment loss in general is usually here to help compute impairment for those assets which do not have standard that's actually specifically explain how to impair the assets. You know, standard like inventories, IS2 inventories have their own way of computing impairment losses. So that's why not here. This is a big note. Be very careful here. We're saying that no individual asset should be written down below its recoverable amount. This is first of all, it's obvious. You cannot write down an individual asset below its recoverable amount. Let's say you have your asset in the books at 80 million, and then you can only recover 60 million. That means you can recover it at the maximum of 20, from 80 to 60. That means you can only recover it at the maximum of 20. So even if you perform the pro rata basis and you'll find that actually the impairment is much higher than what should have been the true impairment, actually that is not allowed. So we are told that it means that unless it's specifically impaired, current assets are unlikely to be impaired as part of a CGU. This is our main point here. Current assets. So if you are given no information about current assets, just do not impair them. Leave them as they are. Do not include them as part of a pro rata basis. Leave them as they are. Leave current assets alone, right? So why we are told that this is because they are already likely to be carried at their recoverable amounts. So don't stress about that. And lastly, we are saying that, for example, inventory is outside the scope of I-36. As I told you, IS2 inventory has its own way of computing impairment loss because inventory is measured at the law of cost and net realizable value. That surely computes its own impairment loss, so no need to waste your time. Now let's go to a worked example from ACCA exam past papers and see how to deal with this. Actually, in the previous videos, we started about this question 1, we did it. Then we went to question 2, but question 2, we did this section here. We did section B Roman 1. Now we're just going to B Roman 2. Yes, here. Here we are. Now the question starts here. We are told that Telepath owned 100% subsidiary. I think you know the meaning of subsidiary. You are just a parent and you own a subsidiary. And don't worry, we also study consolidation of financial statements. We'll be doing that soon. So Telepath owned 100% subsidiary, tilde, that is treated as a cash generating unit. Of course, in the practical sense, a cash generating unit is a subsidiary can usually be treated as a cash generating unit. So we have something like this. And we are told here that on 31st March 2012, there was an industrial accident, which was a gas explosion that caused damage to some of Tilda's plant. Now, the assets of Tilda immediately before the accident were, now you have to see this. Immediately before the accident, this was the value of the assets. This was before the accident. So we had goodwill like this at 1,800, 1,800 actually $1,000. Then we had patent, $1,200, $1,000. Then our factory building 4,000, plant 3,500, and receivable and cash, which are current assets, is 1,500, giving a total of 12,000. This was before the explosion occurred, right? I'll repeat again, this was before the explosion. Now, as I told you, when computing impairment loss of a CGU, you do not need, right here, you do not need to perform impairment review to see whether the value of the asset has fallen. Let's say you have a plant has totally been burnt. It's obvious that its carrying amount will be 0, and so you write it down. So that's why before using I-38, I-36 impairment of assets, you have to use your own logic and then perform the impairment. So here we are. We are told that as a result of the accident, now these were the results of the accident. You can use this information actually to locate the totally impaired assets, totally destroyed assets. We are told that the recoverable amount of Tilda is 6.7 million. I think you know this. You know, when in need of computing impairment loss, you compare carrying amount and the recoverable amount. This was the carrying amount before the accident, but after the accident, the recoverable amount was computed and seen to be 6.7 million. Now, what do? We have to know before the damage, it was 12,000. Now we have to see after the damage, after the gas explosion, what happened, what assets were totally destroyed, so that we eliminate them first before attempting to compute the impairment loss. So further information is given. The explosion destroyed to the point of no further use an item of plant that had a carrying amount of $500,000. You see, very, very clear. So this plant here, which had a value of 3,500, we are told that a part of 500,000 was totally destroyed. So it was destroyed to the point of no use. So even before applying the principles of impairment, you will have to remove it because it will no longer be there. It will be no more. So you remove it there. And then you are told Tilda has an open offer from competitor of $1 million for the patent. You know, you see, now after that, the patent, someone has come and offered $1 million to purchase the patent, which initially had this value here, 1.2 million. You know, you had held $1,000 at the top. So it had this value, but now someone is offering to buy at just 1 million. It indicates some kind of impairment. But also we are told that the receivables and the cash are already stated at their fair values, less cost to sell at their net realizable value. Unless otherwise stated, as I said, presume the current assets to be at their own recoverable amount. Presume that they have already been, they are already at the recoverable amount, so nothing to do. I think before doing this question, all right, let's just proceed with the question. We are told, calculate the carrying amount of the assets in Roman 1. Roman 1 is just the impairment of a normal asset, which we did in the previous session. And Roman 2 here above at 31st March 2012, after applying impairment losses. Calculation should be to the nearest $1,000. Now, this is our question. So you just have to follow those principles and reach at the conclusion. Let's just go and complete this part here. After here, everything will be fine. So as I told you, you first go to the solution. This is part B, not this one. This one is, yeah, here we are. Now, as you see this table, you have to understand very carefully what happens. You know, originally we had these assets. We had goodwill at this figure here, 1,800. We had patent at 1,200. This was the pattern that we had. And then we had a factory. We had a factory at this 4,000. And then we had plant at 3,500. And then we had receivables and cash at 1,500. So this is just what we had. We have just copied from the question, right? This is what we had. Now after here, this was the original figures before the accident. Now let's see what happened after write-off of totally destroyed assets. Some assets were destroyed. Now goodwill had no issue, so it will just remain the same. Now we go, patent had no issue. It will also remain the same. Factory had no issue, it remained the same. But the question told us that 500 of this plant was totally destroyed. So by removing 500 from 3,500, we remain with just 3,000, right? Let me show you, because this is some kind of essential. See here, back to the question. Here, right here, right here, right here. Here, this one, 5,000. We are told that the explosion destroyed to the point of no further use an item of plant that had a carrying amount of $500,000. So that's why you have eliminated from the plant this 5,000. And then Tilda has an open offer from a competitor of $1 million for its patent. So the patent just fell down in value. So let's just go there, the question. Here is our question. We proceed. Receivables and the cash had nothing to do. Now, if you do this, actually, this total value will change. You add these values and you remain with 11,500. That's the first step. Then after that, this is the carrying amount, a new carrying amount, and this one is actually the recoverable amount. Now we just need to see here whether there is an impairment or loss or not. As I told you, after here, you just go to goodwill. Purchase goodwill is very, very volatile, so try to impair it as much as you can. Now, how do you do? First of all, had this impairment, this carrying amount of 11,500, but the carrying amount of the CGU, recoverable amount of the CGU was this one, 6,700. This was the recoverable amount. So since the carrying amount is greater than the recoverable amount, that means there was an impairment loss, the difference of which is 4,800, which means 11,500 minus 6,500. Just the difference, this one minus this one, and you obtain this one. Then after here, how do we proceed now? We start charging our impairment. Now, as I told you, if it's possible, impair goodwill by all the amount. Now, the total impairment loss here, which is the difference, is 4,800, but goodwill had only an amount of 1,800. So since it all falls here, you impair goodwill by all this amount, which is 1,800, just like this. And if you do that, you remain with the value of goodwill as 0, meaning that goodwill has been totally impaired. In case the impairment was just, let's say, 1,000, I would just impair it by 1,000 and I would remain it here with 800. So just like that. After there, as I told you, current assets, unless otherwise stated, just presume them to be at their carrying amount, revise the carrying amounts already. So 1,500, you just copy here 1,500, meaning that no impairment has occurred to the current assets, unless otherwise stated. If it's clearly stated, then you have to change, but if not, just leave it as it is. Now, after that, you remain with assets. No, we are given some information on patents. We are told that the patent now can only be bought at $1 million from the question. So if the patent can now be bought at only 1 million, can be sold at $1 million only, that means there is an impairment from 1,200 to 1,000. Impairment by how much? 1,200 minus 1,000, and you remain with $200, just like this. Then after here, we just remain with two assets, which is the factory and plant. And you got no way, there is no other way than actually allocating the impairment loss on a pro rata basis. So you just allocate on a pro rata basis and you reach your solution. So here, if you just try to look at what amount